Ladies and gentlemen, welcome back to the Crypto News Podcast. It's your host here, Matt Zahabu. You're buzzing as always, folks. A little bit of a flu game for me today. Woke up out of nowhere, felt great all week, and sick as a dog this morning. I'm sure you can hear it in my voice. Same as my girlfriend. She woke up also sick as a dog. Sometimes shit happens. As well as Canada's, one of Canada's biggest, well, technically the biggest cell phone and data provider, Bell, was also out this morning. So we had to reschedule this podcast. So shout out Bell, Canada dropping the ball again. But enough complaining. Grateful to be here. And we have one of the best dressed lads in crypto on the show today, coming in hot with a biker jacket. He looks like he could be not just the co-founder of a huge crypto platform, but also he could be in Harley's Angels. Jesus. Today we have Marcin, co-founder of RedStone Oracles, the fastest growing blockchain oracle backed by Arrington Capital. He's been in crypto since 2017 and has played a key role in developing several innovative DeFi protocols and prototypes. Previously a Google Cloud PM. He's also the co-founder of ETHWarsaw and snagged the Forbes 30 under 30 in Poland. Huge blockchain guy, huge cross-chain infra guy, DeFi apps, you name it, he's done it all. Marcin, welcome to the show, my friend. Pumped to have you on this morning. How you doing?
Hey Matt, I'm doing really well. Wow, that's one of the best intro I got in the crypto podcast game. Today, usually I'm in my red vest that is from RedStone, that it's a really nice weather here in Warsaw. So I was just like, okay, let's put that jacket. I didn't know that someone would call it out, but I appreciate the compliment a lot. And well, you were not feeling so well today, but thankfully the market is doing quite all right. And
Yes.
a lot is happening out there. Especially in the Oracle game, we are thriving, and I'm super happy how everything is going on. So great to be here.
Love it. Yeah, you're definitely making me look bad. I want to say it's 6 degrees, feels like 4 today in my parents' place in Aurora, just north of Toronto, which is insane for almost end of May. It's like, what are we doing here? But let's go back to the market though. Market's sort of ripping. I'm sure maybe I'm like you, maybe I'm not like you. Unfortunately, part of my morning routine is opening up CoinGecko or CoinMarketCap, and I'm usually checking what happened while I was sleeping. Another good day. Are we back yet, or do we still have a little bit more pain to go?
Well, we've never been down, I suppose, at least in my view. So no, look, Bitcoin is very close to all-time high. ETH went up like 50% in like 3 days or something. I don't exactly know how quickly it was, but I would say the market is really good. But I'm not a trader, I'm a builder. And what I can tell you is I've never witnessed so many serious TradFi players being interested in the space, talking about stablecoins, tokenization, the potential that on-chain finance brings. And that's why I can tell you we are very, very much back, not from the even perspective of the price in the market, but what's the potential and what's ahead of us. I'm extremely bullish.
I agree with you. Every week, it seems like, I remember back in, I want to say 2022, 2023, again, same as you, probably spending way too much time on crypto Twitter, just not a whole lot. Obviously it was a bear market, but not good news coming out every single week. And now it seems like it's literally every hour almost. There's like a really good piece of forward-looking news about a huge company or huge person XYZ is joining the space to help, provide a solution. We absolutely love to see that. When this opportunity came across the desk, this was a huge one, not only, because of you and RedStone, but the Oracle narrative is really, really heating up. Crypto is literally just combining sort of, physical and digital. And that's what you guys and a lot of teams are doing with oracles and data. I'd love if you could talk about, the infrastructure powering the future of finance and how it really, a lot of it does come down to oracles and what you and the team at RedStone are doing to continue this adoption here.
Yeah, happy to start. So as you mentioned, I've been in the crypto since late 2017. I wrote my bachelor thesis about blockchain, Bitcoin, and early Ethereum days. The potential of smart contracts disrupting the finance space. At that time, people were screaming, okay, smart contracts are going to replace the whole financial system. Banks are not going to be needed anymore. Fast forward to 2025, I believe everyone would agree it's going to go in parallel, like in a converge and conjunction rather than one on the other, right? Like it's a symbiosis that it has to cooperate with, because there are some cases where TradFi is just more reliable, I would say, or more trusted via regular players. But there are many, many use cases where the blockchain technology is like literally disrupting and making the process a magnitude of levels like more efficient or just quicker. And with oracles in 2020, when we started RedStone, we saw complete dominance of Chainlink, which is still the biggest oracle on the market.
Yeah.
At that time, they had probably like 90% of the market, which was huge. But we identified very early the structural limitation of theirs, which is monolithic design that is hard to scale to plenty of networks and plenty of assets. That's the reason from day one at Redstone, we said, okay, we create a modular architecture that is ready to support thousands of blockchains, hundreds of thousands of assets, and infinite number of clients. Because if you want to play the long game, you have to start with like really good fundamentals and principles. And that's how we've been rolling fast forward to 2025. To this day, we raised $23 million. We launched the Red token in March 2025 that is powering our Redstone AVS, actively validated service on EigenLayer that secures our network. We have over 150 clients, including Compound, Morpho, Pendle, Ethena, Securitize, and so on and so forth. And we are the fastest growing on the market right now, and we are nowhere close to stopping from, our acceleration.
You guys are absolutely tearing it up. Let's talk use cases here. When most people, Marcin, think of oracles, I think, and I could be wrong here. I'm putting myself in the shoes of most people here, but they probably think of price data right off the bat, right? Like being able to aggregate a bunch of different prices, get that data super quickly, push it out to where you want it to be pushed out to, so that consumers like myself can then, get the best price from an oracle like you guys. And again, they're not really using you guys. It's the platforms that are using you guys in order to, to get that data. That's the obvious. And I'd love you to just touch upon the importance of that too, and also tie it into some other use cases and perhaps even how institutions are using your guys, RWA data for their RWA applications as well. Just go in a nice big deep dive on, the importance of oracles and pricing. And then also, besides pricing, stuff like RWAs and other really cool, unique data points and how you guys use them to move the needle.
Wow, a really broad question. I like those. So let me try to break it down into pieces. Let's start off with Oracle. So there's an Oracle American corporation, which is huge. Please don't associate that corporation with the Oracle as the sector in crypto, because when I go to TradFi conferences educating about blockchain, whenever I say Oracle, this is like their first association. So it's important to also make sure people are on the same page. So oracles is this component or like a category in crypto that delivers data feeds to on-chain environments and dApps, like the clients. And that data can be anything, because blockchains live in separation from external sources of information. So Ethereum blockchain has no way of asking Google or ChatGPT of the information. It has to be an adapter, let's call it an oracle, to deliver that information. So technically, we as an oracle can deliver any integer you're going to ask me. Now, talking about reality, in 2025, 95% of the data is market data. So we don't talk about, let's call it user data, so about specific people. We don't talk about railway data. We don't talk about medical data. We don't talk about all of that. Like, this is possible, technically possible, but majority of the use cases right now rely on the market data. And then you go even a step further, and it turns out like from this 95%, again, about 90% is price data. So information about pricing of the asset. The remaining 10% can be about volume, can be about some interesting statistics, like specific use cases, but price is what trumps everything else right now in the Oracle game. And in traditional world, how it is solved is mainly by a Bloomberg terminal. Bloomberg terminal is like a very known tool used in traditional finance traders group, where they look at the charts and information that Bloomberg provides, and they take their financial trading decisions upon that. So they could technically go to, I don't know, Yahoo Finance or some other platform, but Bloomberg is just a kind of like a standard that everyone believes and trusts. This is a very interesting day, 21st May, that we recorded, because this is the first day I've heard that Bloomberg terminal has had problems. If you type into Google Bloomberg terminal downtime, you're going to read that today for about 1 or 2 hours, especially in the UK, Bloomberg terminal had like hiccups, and some of the UK debt transactions were disrupted because of that. And that shows the consequences from Bloomberg terminal are, let's call it disruption, like some problems, but it's not havoc. When Oracle doesn't deliver data or delivers bad data, it can literally mean a nuke for a specific project. Why? Because smart contracts don't wait. The moment a smart contract gets an input, it executes. That's the nature of smart contract, right? Like it's like permissionless. It just does what it's supposed to do the moment you deliver it a specific input. And this input is delivered via an oracle. So imagine there is a smart contract that says the moment Bitcoin hits $50,000, so drops to 50,000, it should be executed. If an oracle delivers fraudulent data that is 48,000 just once on chain, just once, like you've been correct 364 days a year, 23 hours, 59 minutes, and 59 seconds. This 1 second, you deliver one bad data point. And if it's a huge contract that relies on that one price point, it can get liquidated or some other domino effect can happen. So that's the reason oracles are so important in the crypto space. And now, up until, I would say, 2023, 24, majority of the data was around crypto information. So Bitcoin, ETH, Sol, USDT, USDC, because they are, some people deem them $1, but some people recognize that sometimes they trade at a small premium or discount. So for example, $1, 2 zeros and 1, right? And for protocols with huge volume, it does matter that the price is like literally what currently the market is pricing that stablecoin about. And in 24, we've seen the surge in need for traditional finance data, starting with commodities like gold, like silver, stocks were also interesting, but stocks is a bit more tricky in terms of like regulatory aspects. But there was this starting to see this converge between one and the other. And now, since Trump has been elected in the US, majority of the people that had ideas of cool use cases with blockchain, but were stopped by the regulatory landscape or fear that their project would not take from the ground because of the political situation in the States, started to blossom again in the States. And it turned out that tokenization is the beautiful use case. Securitize is an excellent example where they launched BlackRock Biddle, I believe, 1 year ago, around May last year, as far as I remember. And now it's about $3 billion tokenized asset already.
It's wild.
Van Eck, yeah, it's wild. Van Eck announced their tokenized product as well with Securitize. Apollo has a tokenized credit, which is even more interesting. We can dive into that in a moment. And for all of those products, the moment you tokenize an asset, you have a digital representation of it on chain. So there is something in regular world and their custody, for example, of Securitize or someone else like a custodian. And then on chain, you have a representation of that as a token. The issue is this token doesn't convey the information about the price of this off-chain asset. It just represents it, right? So it's a kind of like a digital footprint, let's call it. And we as an oracle track the price of that thing that lives in the off-chain world. So for T-bills, it's fairly easy because the rate of T-bill is fairly predictable and it updates only once a day. But tokenized credit, for example, that has a very variable rate, even like based on daily accrual. So this is what we deliver on chain as the oracle. And as I talk more and more with TradFi people from banks, from big hedge funds and institutions, they have more interesting use cases of which I cannot talk everything yet because of the NDAs, but I will try to share a bit more in a moment.
Give me a hint, like what area? I know you got a little excited when you brought up private credit. Is it something along those lines? Because I know the private credit market is absolutely on fire right now.
Yes, and there is a protocol called Maple Finance that I highly recommend checking out. I recently, if you check on X or Twitter at Marcin RedStone, which is my handle, I recently wrote a pretty good thread about Maple, which brought me to one of the top KOLs about Maple. I was just like, hey, this is a cool platform. Let's write a thread about it. Like literally, I know Sid, who is the founder, and I know he's a builder because they already witnessed one nuke, which was FTX, Free Arrow Capital, and the whole drama around the defaults at that time. And I believe it was Free Arrow that was a pretty big borrower in Maple. So some of the loans went bananas, went default. But now Maple is growing very, very well. And I believe it's going to be very well positioned in the upcoming run and cycle. But private credit goes way beyond on-chain infrastructure for crypto loans, because essentially that's what's happening on Maple. Like there are two parties, they're matched, and on-chain, let's call it engine, is utilized to make the loan happen. But majority of those loans are about crypto to crypto kind of like situations. And the traditional credit that you're talking about in the United States or even Asia, this is like enormous potential, because in TradFi, like regular one,
Huge. Yeah.
the market is big, and also the fees are really huge. So there is a lot of room for crypto to disrupt that market and make it more efficient. So that's where Apollo, BlackRock, and the biggest hedge funds of the world are literally looking right now, like how to make it regulatory compliant and in a way that will ensure it can literally explode on chain with the smart contracts and blockchain infrastructure.
Wow, what a start. Marcin, you're on a roll here, mate. We got to take a quick break, give a huge shout out to our sponsor of the show. When we get back, we are going to continue to buzz on everything Redstone related, and we're going to get into institutional RWAs and, of course, the future of DeFi. Till then, huge shout out to Prime XBT, longtime friends and longtime sponsors of the Crypto News podcast. We love the team at Prime XBT as they offer a robust trading system for both beginners and professional traders. Doesn't matter if you're a rookie or a vet, you can easily design and customize your layouts and widgets to best fit your trading style. Prime XBT is also running an exclusive promo for listeners of the Crypto News podcast. Use the promo code CryptoNews50, that's CryptoNews50, all one word, to receive 50% of your deposit credited to your trading account. Again, that's CryptoNews50, all one word, to receive 50% of your deposit credited to your trading account. Marcin, you are on fire here. Also, just dropping alpha bombs on the podcast, letting everyone know about Maple. I did do a little bit of a dive on Maple, but not a deep dive. So that is on my to-do list for the rest of the day. Let's talk RWAs. RWAs, super, I mean, I don't even think they're still super, super trendy. I think that was more like early 2025 and late 2024, but you guys are actually doing really incredible work with them, and I'd love to know what you and the team are doing, your partnership with Securitize, and how you guys are working with like the biggest firms of the world like BlackRock and Apollo.
Of course. So RWA, for those that haven't followed, is real world asset. And it means usually nothing else than taking an asset that is in traditional world and tokenizing it.
I don't love the
Go ahead.
term, to be honest. I don't know about you, but I think we could have done a much better job and came up with a much better acronym than RWA. I think it's sort of ass, personally.
To be honest, it's not the biggest problem of our industry. I can tell you the biggest, because I talk a lot with TradFi or normies, because I have like a personal mission of expanding not even utilization and usage of blockchain, but the knowledge about it. So people are just more aware what's happening between the TradFi versus the on-chain rails in general. And the biggest problem I encounter is cryptocurrencies, because people think crypto, which is like, sketchy, someone is anonymous and so on. And to my knowledge, at least, the reason it's called cryptocurrency is because of the cryptography,
Yes,
which is the fundamental strength of the technology, showcasing that it taps into mathematical, segment that ensures the data is like secure and encrypted, which is like very unfortunate. But here with RWA, at least it gives you a hint of what's going on, like real world assets. So you can think of something that is in the real world and then it's tokenized, right? So I don't like the term, but I don't believe it's the worst that we could coin. Cryptocurrencies, I really don't like, and I way more prefer digital assets because it conveys for a normie way better what's happening like under the hood. But okay, talking about real world assets, it's mainly about tokenization. So you can take, for example, a real estate, you can take any kind of like a treasury bill, you can take dollar, and you can have an on-chain representation. So the most popular use case right now in crypto is actually stablecoin. Stablecoin is nothing else than tokenized US dollar. Tether, for example, is taking custody of US dollars in a bank account or somewhere else, and then is creating token representation on chain. And the process is not much different when you take any other asset out there. The biggest difference will be probably that with stablecoins, at least the issuers always assume it's $1. So you can mint and redeem for one. When it comes to other assets like real estate.
Great point here. Great point. Keep going. Great point here.
Yeah. So that's one of the reasons it was so popularized, because it was like extremely simple. Like there was nothing. The biggest problem could be when liquidity crunch could come. So many people would like to redeem, for example, USDT for dollar, and then it's a kind of like I check, like in poker moment, like whether you have the treasury and available liquidity to pay it out or not. Hopefully, right now it's already solved and it's present, but in the past it was a bit of a question mark. But now when you tokenize like those kind of other assets, the value of the asset that you tokenize is moving. It can either go up or go down. So there are some assets, like for example, for treasury bill to go down in value, like the US one, I don't know if it's even like possible. Like the economy would probably like literally collapse if tomorrow, like for whatever reason, the rate was negative, right? But for tokenized credit, in example, if there is a default in the credit fund, because how credit works is, in very simple terms, there is a person that has money and wants to lend it, and on the other side, there is a person who wants to borrow it. So they do the transaction, and then the lender gets yield on it. Let's call it 6%, and then the borrower pays for being able to borrow. Let's call it 5%, and 1% in simplistic form is what makes the platform running, right? So there always has to be some kind of cut or a fee on the transaction. So there's economical reason for that to happen. And if you do many of those loans, this is what we mean by credit, right? Like if you create like, let's call it 10,000 or hundreds of thousands of such borrowing loans, you call it like as a category as a credit. And then you can even make products out of the already created credit. So you can take, for example, 10 of those loans and then you package it into another product. And basically fast forward, this is how CDPs and the whole financial crisis of 2008 happened. But if you're interested in that, watch the movie Big Short, because this is very interesting. But for the sake of this podcast, let's just focus on those very simple borrow and lends. And imagine there are 10 of them. And you package those 10 and say, okay, now like the aggregated yield is about 9%. In very simplistic words, this is what Apollo with Acred is doing. Like they're having this credit in traditional finance. They package as a product. They say, okay, if you give money to us, to Apollo, we are going to utilize that for those credit activities, and we pay you 9% yield. So you don't have to look into every single credit out there. We manage that, but we give you aggregated 9%. And the problem is how the fund is structured when some of those loans and credits default, right? Because there can be a situation like with Free Arrow Capital that the borrower, someone who had borrowed, goes bananas, like goes under, and then the borrowed amount has to be written off. So basically no one is going to repay it. And now if you package many of those loans, for example, I told you 10, but imagine for simplicity, there's 100. If only one defaults and it wasn't like a huge one, let's call all 100 are the same size, right? So we create a product that's all the same size. If only one defaults, it might not be such a big problem, right? Because there are 99 others that have the yield or the fees that can cover for that one. The issue is if there's like any kind of like a domino effect, and this is the problem with finance, that many times it happens that if one defaults, then it turns out that someone else was creditor to that, and then it just goes on and on. Okay, I've been talking a lot, and now the clue. So you have this Acred, which is the tokenized credit from Apollo, and they have it on chain. Acred, as the fund, changes the value every day, so it accrues the value. And what you can do it with on chain right now, for example, on Polygon, on Morpho, you can go to Polygon, mint Acred, which is
synthetic.
It's not a wrapper,
but
it's a synthetic. I mean, okay, now we go into technicalities. Like, it's not a wrapper; it's more like a synthetic asset. So, like, again, a representation of a tokenized asset that you can utilize in DeFi. Why you do so? Because Acred, like the pure one, is a security. So you cannot send it between people. And the issue is, if you can send it between people, you cannot liquidate such a position. Because imagine the position is under.
It's safe. So it stays safe.
Exactly. So liquidator wouldn't be able to take this Acred and liquidate on the open market. So you create this Acred, which is a representation one-to-one, and you use that one in DeFi for your collateral of a loan. So imagine you have Acred that accrues 9% over the year. You go to Morpho on Polygon, which is actually live right now, and it's powered by RedStone. Gauntlet is the operator of the vault. Morpho is the DeFi protocol, and Polygon is the network. Many players out there, I know. And then you can go there, you can put in your Acred, let's call it 1,000 units, and you can borrow against it ETH. For example, you think ETH is going to go down, so you essentially short ETH, or you can borrow dollars. And now if you borrow dollars for, let's call it 8% or 7%, even better, then you have the 2% benefit of such a position. So what you can do with that, again, if you borrowed, for example, USDC, You can go again to Apollo, put that, okay, transfer this USDC probably to USD because Apollo is accepting like regular dollars. Or you can take SA credit from on-chain contract. Like depends like which road you can do, you want to go. But essentially you can take those dollars that you borrowed and again get SA credit and do the looping. And this is where this 100x moment comes in because looping is not allowed in TradFi. That's one of the reasons people are so excited about the on-chain looping, because we've seen how effective it has been with liquid staking tokens, liquid restaking tokens, with Ethena, with Resolve, with all those other yield-bearing assets, that people were just taking leverage on an asset that has a very deep yield source that is coming from. So in case of liquid staking tokens, that's Ethereum staking. And in my opinion, that was an inflection point for crypto, like the moment liquid staking tokens went into the market for looping. Then we had liquid restaking tokens. The yield was eigenlayer. For Ethena, it's funding rate. And for ACRED itself, it's the tokenized credit from the traditional finance world.
That story, again, this day will not stop here, mate. At the end of your spiel there, a bird literally just flew into my parents' window. That was all world though. So you are very, very bullish. And again, I hate using the word bullish or bearish, but I guess it does do a pretty good job of really, distilling what you're trying to say and getting straight to the point. But you are obviously very bullish on the tokenization of private credit. You think trillions, and the private credit market is a multi-trillion, it's one of the biggest markets in the world. I think after like bonds and FX, I think it's number 3, maybe real estate, but regardless, you are very, very big on this and think that all of traditional finance, TradFi, private credit market, which again, $1 trillion market, will be moved over to Web3 and will be tokenized.
I am bullish, or if you want another word, I'm extremely excited. Like literally when I'm talking about that and my brain realizes the potential.
I could see you, yeah.
Yeah,
You're
because
fired
look,
up about it. I love that.
Look, I haven't been that excited since liquid staking tokens entering DeFi. Because liquid staking tokens entering DeFi was the moment that brought crypto, again, in my opinion, to another level, because it has shown that crypto can create a new yield primitive that is not present in traditional finance, that is very deep, which is the proof of stake blockchain, but just liquid, right? Like you don't have to have 30 to ETH or whatever sol it is right now that is required to run a node. You can just try to make like bit by bit, like chunks of it. And then for those who are very believers in this yield, they could put leverage on that. Like this is one of the reasons Aave grew so much. Like if you go into the statistics of Aave, majority of it is still Lido wrap staked ETH looping. So literally this is what brought DeFi to another level. And since then, I was really excited about Ethena and the whole like funding rate, synthetic dollar kind of like meta. But that one, I'm not a trader. So for me, it's a bit harder to understand like how sustainable it is and deep. So far, Ethena has proven itself that it is very, very deep, and people keep trading meme coins or even Bitcoin or ETH on leverage, and this funding rate is, $1 billion possibility. And I'm very glad about that. And now the third generation, in my opinion, that is going to drive a lot of growth in the long term is this tokenized credit, or in general, tokenized funds, tokenized financial products from the traditional world. And I wouldn't say it's going to all migrate 100% to crypto, but I do believe a big chunk will migrate. And even more important, new players that in traditional finance wouldn't be interested in that or have a position to engage in it will do so in crypto, will do so when the limits will be lower, because usually when you disrupt such a market, then the new entrants have lower barriers to enter it, and new players are also emerging. So the old ones that have a lot of cash and no much incentive to move, let's call it, they are like, okay, let's do the things the old way. So we've been doing that for 20 years. Let's keep it doing so, because I have children and I don't want to, move that much. Of course, I'm not talking about everyone, but there are many people like this in TradFi. And then this disruptor comes. It can be also an older person. Like yesterday I had a meeting with a guy that is 60 years old. He's a legend in the Polish banking system. So he opened a bank in 2002 and then another one in 2009. So financial crisis, and he opened a bank in Poland.
Wow.
And this guy is bullish tokenization. So he has a new platform that UniCredit bought in Europe. UniCredit is a bank from Italy, and those guys are extremely bullish tokenization. I had a meeting yesterday. So those kind of people being excited about the technology is the inflection point. And I believe the market still hasn't realized that those guys are not anymore talking, like they're implementing, because they know with the Trump administration for the next coming years, it's going to just boom and no one is going to stop them. And there is a lot of efficiency to be opened.
Marcin, what an episode. This was a treat. I wish we had more time, but we are fully out of time. That was incredible, man. You do have some news. Do you want to drop that or no? Because it might go live after the pod. You want to drop it?
Yeah, of course. I mean, well, this is not a secret that RedStone started in EVM world, so Ethereum virtual machine blockchains, but we've already expanded to Ton, Sui, and I'm very happy to share that RedStone is live on Solana. So I'm not sure if the full announcement is going to go before or after the podcast, but those who are going to watch it are going to have a really pleasant, alpha. I know it's good to have alpha when you watch something recorded. And feel free to follow myself on Twitter, Marcin Redstone, and Redstone_DeFi as our whole project as we keep cooking.
Folks, what an episode with Marcin, co-founder of RedStone. He was absolutely on fire. Alpha left, right, and center. Big deep dive on everything blockchain oracles related. And my favorite part of the show was the big rip on tokenizing private credit. Wow, that can be an absolutely huge market for us, and we can really make some moves in the space. Huge shout out to Marcin and the team for making this happen. If you guys enjoyed this one, I hope you did. Please do subscribe. It would mean the world to my team and I. Speaking of the team, love you guys. Thank you so much for everything. And back to the listeners, thanks for tuning in as always, and keep on growing those bags and keep on staying healthy, wealthy, and happy. Love you guys, and we'll see you on the next one. Ciao.